Welcome to the Robert Hunt Financial Market Update YouTube live video version. I'm here with the understudy boy wonder, Bobby Hunt. He's with us because he too wants to learn about investing. Isn't that right, boy? So on this YouTube live, I want to talk about the Federal Reserve. The Federal Reserve and their decision making is all over the news right now, and it's poignant. It should be all over the news. It is affecting our investments. But I'd like to help us understand the why behind that. I want to focus in particular on a Wall Street Journal article that came out this week by Karen Langley. It says, rising interest rates squeeze stocks on both sides, constraining earnings, multiples. So that subheadline, stocks fell and government bond yields rose to multi-year highs Tuesday ahead of the decision by the Fed's rate setting committee. What does all that mean? Okay. So the Federal Reserve, the rate setting committee, they're deciding what the Fed funds rate is, which is what it costs banks to borrow money from one another. It is in many ways the benchmark by which other lending instruments set their pricing. So it affects a whole host of instruments, financial instruments. And why are they doing this? Why are they raising rates? They feel this will slow down inflation, decrease the velocity of money in the marketplace, get a hold of inflation. Because as you can probably appreciate, we have some inflation. So why does this squeeze stocks and bonds? Like why are stocks and bonds worth less the higher interest rates go? Well, it's an earning stream. A stock at its simplest valuation form it's an earning stream or a future earning stream. So you may look at Facebook, Meta, and they don't pay a dividend. Where's the earning stream? Well, they have a lot of earnings. So the market is anticipating those earnings will eventually reach their pockets. In the same way, if you look at AT&T, it does pay dividends, but that dividend stream is worth less the higher interest rates go. Because if I tell you you can do a risk-free rate, U.S. Treasury rate at 4%, or an AT&T 4% dividend yield, what would you have? All other things being equal. I'll take the risk-free yield. So what happens when the Federal Reserve is raising these rates? All of a sudden, risk assets are less desirable. It's less desirable to have stocks, and it's less desirable to have bonds because the yields on those bonds. If you have a bond that you own that's a 2% coupon and the Federal Reserve keeps raising rates up to 4%, that bond is now worth less. It has to lower in price. And now we're getting a little complex. We can do this. It's lowering in price so that the yield is competitive with prevailing market interest rates. So what does it mean? It means bonds need to go down in value in order to be competitive. And it means stocks are going to go down in value. Now, what the market is currently anticipating is that this will just be a little bloop. Jerome Powell will raise rates. We'll have a couple years of this. He'll lower them back again. All is well. All will be well. I don't know. And neither do you as an investor. I think it's important to understand. I think it'll demystify and take some of the boogeyman out of the Federal Reserve and what's happening with our investments. I think that can help us stay the course, which is the point of me doing this right here. The answer is stay the course. That's the Spark Notes. That's the cheat sheet. Just stay the course. Don't try to anticipate what the Fed's going to do. Don't try to anticipate what other investors will do in anticipating what the Fed will do. All of a sudden, you see how complex that gets. Just stay the course. Know why it's happening, though. None of us want to just be ostriches with our heads in the sand. We at least want to know why something's happening. But that's all that's happening right now. The Federal Reserve is trying to get a hold of inflation. They're raising those rates. It makes current cash flow streams worth a little bit less because now investors can get a risk-free rate on the 2-year Treasury, for example, about 4%. As an investor, take that 30, 40, 50-year view. For all the investors in the 70s that threw in the towel on stocks because they just couldn't handle Paul Volcker back in the day raising interest rates. He was the Federal Reserve chairman. They bailed. Not good for them long term, right? It would have been much better if they had simply stayed the course, dollar cost averaged over that time period through their job, their 401k or whatever. They didn't have 401ks back then. But if they had just contributed money consistently, that would have been the key. So that's why the Fed's doing what they're doing. That's what's happening. Bob, any final words for the group?
Yeah, that I like that to stop.
Okay, sounds like a good time to pause.